Hi, in this video, I want to talk about market structure, how to properly define market structure, and why you need it in the first place. When we talk about market structure, we're talking about how the chart is currently lining up in that particular stretch. And this is very important to understand for both beginners and experienced traders who already have their strategies and use them. In general, in order to make it clearer, we can distinguish three groups of markets, three groups of market structure. The first group, the first market structure is a bearish trend. It's a falling trend. The second possible structure is a rising trend, a bullish trend. And the third category, the third variant of the market structure is a flat, either a range market or a consolidation. It goes by different names. Let's talk about each of them individually. Let's start with the trends. Bearish trend. How can we tell that there is a trend on the chart? Specifically, it is a trend, and we can call it a trend. After all, we can't just look at whether our candles are green or red, or basically where the chart is headed. If it's falling, then we're necessarily trending down. It's not. In fact, a trend has one very important thing that allows it to be defined as one market structure. It's updating highs and lows. If we talk about a falling trend, we define such a structure as a falling trend, which means that every next high must be lower than the previous one, and every next low must also be lower than the previous one. That is, we have a chart falling, going into correction and drawing a new local high. This local high should be lower than the previous local high. Next, we have a continued decline, the trend continues, and we have a new local low that is lower than the previous local low. The chart bounces again, goes into correction, and the new local high is higher than the previous one and the previous two. And so on, we have a local low, a local high, a local low, a local high, and they are all lower than the previous value each time. And on this particular chart, the trend ended here, because here we see the breakdown of the structure and the emergence of a new structure. Here at this point, the chart went flat. Later, we'll talk about how to find the points where the structure of the graph changes, and we have to act differently. Let's look at the next structure option, which is a bullish chart, a bullish trend. Actually, bullish or rising trend, it is defined in the same way as a bearish trend. You have the local low and high constantly updating and getting higher and higher. A bullish, rising trend, it shows first growth, we have a new local high, then there is a correction, we have a new local low. After that, again, continuation of growth. Local high, local low, local high, local low. And each time the lows and highs should be higher than the previous ones. In this case, we can talk about a bullish trend. And the third market structure is flat. In flat, the chart does not have a clear trend, at least not a long-term one. Here we can call these movements small trends, but in fact, if you look more closely at the chart, there is no trend, and the chart just fluctuates between levels. There are three market structures, and it is very important to be able to distinguish between them, because depending on what market structure you have defined now, whether it is trend or flat, we will act differently in our rating. Let's start from the opposite. If we see that the chart is flat, it means that we are acting from horizontal levels. We look for local resistance levels on the chart from which the chart has bounced down in the past and plot them on the chart. Here, let's say we plot them on a graph. Here's the intermediate resistance. Here, for example, we can mark the main support level. We're not going to fully break down the chart right now. It's just for the sake of understanding. Because when the chart is flat, we mark horizontal levels and wait for a bounce from them. We assume that as long as the chart is inside these lines, we are highly likely to make money, but on bounces from resistance down or support up. Support resistance are lines that charts have often bounced off of in the past. And seeing such a chart, we can understand that in the future, we are waiting for a bounce down to this level here and a bounce up from here. If this level is broken, we are waiting for a rebound upwards from here. And we look at the market horizontally. and we look for horizontal levels. If we define the market structure as a trend, for example, like here, then we should already use trend tools. In the case of a trend, these are mainly trend channels, which are built by local highs and local lows. Here we have built a trend line on the local highs, here on the local lows. As you can see, these are such, you can say, not horizontal, but diagonal resistance support levels, from which there is a rebound, but in which the trend is moving. This is the plane where we have updated local highs and lows. But if we see, as we do here, that the upward trend line has not been broken upwards, we can already talk about a change in the market structure. As I have already said, here the chart has already turned flat, and here we should act further on this section by horizontal levels. We should note the resistance support level here and continue to work on them already from a flat perspective, because at this particular moment, we have had a change in the market structure. Now we have a new market structure, and we act differently. As I said, this is the very first step in analyzing charts. Determine the structure, and depending on the structure, draw the lines you want. If it is flat, these will be resistance support levels. If it is trending, these will be trend lines. Also, it is by analyzing the structure that you can mark separately highs, lows, some other important points. And based on the structure we have built, we can look for entry points. When the chart is flat, we can look for entry points either up or down. The important thing is that we have a bounce off the lines. But if we are within a trend, there's that famous expression, the trend is your friend. Trend is your friend. And in this case, we will only consider trades in the direction of the trend. If our trend is bearish, i.e. falling, we consider trades only downwards. If we have a rising trend, we only consider trades upwards. Moreover, these benchmarks that I have marked, resistance support levels or trend lines, can be used as benchmarks for setting stop losses. For example, if we are trading on a flat chart, we can set the stop loss a little further away from the support and resistance levels. And if there is a breakdown, the trade will automatically be closed with a small minus. This is how we ensure against large losses. So, defining a structure is the first and one of the most important steps in becoming a professional trader. You should definitely realize that not every chart that declines is a trend, and not any chart that moves horizontally is a flat. When you see clear market structures, the chart will move much more predictably in them than in a chaotic market, where chart movement is difficult to predict. Therefore, when you start trading, first of all, you determine the market structure, mark the key levels, and only then, taking into account these levels, proceed to search for specific trades. And one more important point is that the higher the time frame that you are exposing, analyzing the market structure, the longer term story it's going to be, and you're going to see the chart larger. And I advise all traders, for example, if you are trading on a time frame of 15 minutes, it is better to determine the structure on the older time frames of 1 hour or 4 hours. The older the time frame, the bigger picture you see. Because this falling trend may just be part of a rising trend. You will only see a small part of the picture without seeing the whole picture. This can mislead you. Be sure to incorporate this step of determining market structure into your trading strategy.